Hello traders, Gary Wagner here about 11 o'clock in Honolulu, 4 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands, day of February 2015, and this is the daily report for gold and silver, our weekend review. And what an interesting week we've had. What a dramatic ending we've had as we see the precious metals under extreme pressure following some data that was released this morning. We do have gold trading dramatically lower, off about $30 on the day, $1234.81. It has had a low of $1229 and a high of $1268 on the day. We did have an active position. We were stopped out. Our stop was hit at, I believe we had it at 51 and a half. We'll detail that trade as we get into the show. First, let's take a look at silver. Silver took a pretty dramatic hit, off over $0.50 on the day, I believe about 56 cents. You can see our current print is 1671. This is a weekly candle. So for the last 2 weeks, characteristics have that they have been lower pricing in each of those 2 weeks. So traders, the first thing that I want to cover is our trade that we did put on this week, in which we went long gold at $1267.50. We went long roughly in this area. I believe it was this candle right here, this green candle, in which we got long. Our sense was that the model that we were looking at, and we're going to go ahead and show how that model now has changed and how we have to work with it, but we did have a pretty clear level of support holding fairly strong over these days. It also came out to a 38% retracement. That was a 38% retracement of what we labeled as our wave 3. So as I said, we went long at 67.50, but we also put a stop in the market, and the stop that we entered in the market was just below this 38% retracement level at 1251.50. The reason for putting it at that point was that that kind of matched this low right in here, and my sense was that if the market could genuinely not hold this particular support level right here, we were probably going to head to either a 50 or a 61% retracement. And if we did that, it really changes our current wave count, because you have a beginning of a wave 2 that terminates right here. And one of the golden rules in terms of Elliott wave forecasting is that the counter waves, meaning wave 2 and wave 4 cannot move into the body of wave 2. So we'll talk about what that means in terms of our model in a second. But so we ended up giving up about $16 on that trade. First trade last month, we picked up 54. This time we gave a little bit of it back. But risk reward is, to me, the most important thing that I can offer traders, because no trader that I have heard of, except for the founder of Candlesticks, who has claimed to have 100 consecutive winning trades in a row. But other than that, the best traders have a percentage of wins to a percentage of losses. And that is part of the equation, along with risk-reward ratios, that makes them either a profitable or not profitable trader year-end. So to wrap the trade up, lost $16. We're flat going into the weekend, but more importantly, it affects our current model. And let me show you my current thinking. And the best way to do that is to pull up the chart that we've been looking at over the last couple of days, short-term chart, 230 minutes, but we've got our basic Elliott wave count. Now, with this recent fall, it changes a lot in terms of our current count, because we were under the assumption, because we had completed our third wave, had a correction that fell within the guidelines, 38%, that we probably concluded and into a fifth wave. Well, traders, nothing could be further from the truth. That's not how this unfolded. Wave 1, wave 2, 61% retracement. Wave 3, 138% extension of 1. We are in wave 4. We are still in wave 4 with one rather large caveat. And that caveat, as I explained, is that one of the golden rules in Elliott wave is that the counter wave, this being here, wave 2 and wave 4, wave 4 cannot go into the body of wave 2. So we've closed just slightly below that, but even in Elliott wave modeling, if the market would rebound from here, and it's a big if, but if the market would rebound from here, this 50% retracement could be construed as valid. We could still look at this as a terminating fourth wave, and we could still create a model which put us in a fifth wave. However, if the retracement that we see in this marketplace takes us beyond that and takes us into the 61% retracement level, well, then we've got a whole different ballgame, because at that point, we are clearly an invalid, we clearly have, an invalid wave count, because you've got the real body of wave 2 and the real body of wave 4 going in there. In that case, we would have to look at our third wave as still being in play. In other words, if the market has this rally and corrects into this secondary wave, what that tells you is that wave 3 has not terminated. So we'd have a much longer procrastinated wave 3, and I don't think that's how this model will play out, because if it breaks there or breaks even below that, then it invalidates the bullish model that we've been working with. So once again, we're kind of at a crossroads, and we will have to see how this market reacts beginning of next week. But the possibilities in terms of how that would affect this model, and more importantly, whether or not this model is valid still, has to do with whether or not it can hold above this top at 1237. If you recall from previous weeks, that number has always been real important. As long as it holds within this area and then begins to trade higher, we can still look at this as a valid fourth wave. This is a valid third wave. We are now into wave 5. If that's the case, then we've got to change our upward extension. So what we would look to do is we would still look for wave 1 and wave 5 to be equal. However, our starting point now for our fifth wave has got to be moved from the previous spot at 54 where it was, which gave us our extension, I believe it was 55 to 60. We're now looking at, and this is if we find support in the market, a much lower target. Our target now is anywhere between 1335 and 1343. Now, this is important. What's important is that we've got to make a higher high to continue to be in some sort of a bullish model. That's one of the critical aspects. And as you can see, the one thing about Elliott wave is there's a big science to it, but there is an art to it. And the art is that if you have a model and the market moves in an extreme way, you've got to be able to immediately see whether or not the most recent move fits within the contingencies of the model, or if the model and that assumption are just flat out incorrect, and then act accordingly. So traders, lastly, I do want to take a quick look at silver. We had no open positions in silver, so we're going in over the weekend flat, both gold and silver. But this is our weekly chart. We talked about this in silver, an engulfing bearish last week on our weekly candles. But lo and behold, if we take a look at this week's candles, because it is a lower low, lower high, red candle, it actually gives you on a longer term basis a sell signal, which distinctly calls for the real possibility that we might in fact see lower pricing next week. We'll have to see how that unfolds. And if you recall from last week's look at our candlestick patterns, we talked about this on Monday, but we had a pretty strong week up until this point, so it didn't seem as relevant. Certainly relevant today, and that is on the weekly charts. In gold, we identified this hanging man, and this is certainly a strong down week. We're getting that confirming candle. We're also kind of matching up with this low here. It's a pretty critical area. So let's see if we find support and it bounces off. If it does not, If it does not, in terms of our downside target, you've got to be now looking at approximately 1219. That's a 61% retracement. 1198 below that, but 1219 if in fact it doesn't find support in this area. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.